Good morning to all. Welcome to the Morning Kappa at 8 on a Wednesday morning. I'm here to present the Midweek Futures Traders Technical Brief. We are on week 4, September 2025. This table is our regular table whereby we show the most popular products traded by traders. And we noticed that this week there has been a very strong performance by most of the markets, especially from the US side, and the indices which we have seen even after the announcement of a reduction of interest rates have continued to move up and trading on positive setup. But there is the agri sector. There has been a move on the downward side for soybean oil and soybean. Later on, we will touch on the news that is affecting the agri sector, whereas the metals has continued on a very strong uptrend as well. Gold, silver, and copper. All these are benefiting from potential further interest rates deduction in the coming months ahead. Coming to our local market, the palm oil has been trading basically on a neutral stance. There is a slight breakdown yesterday, and this is due to the news that the Argentine government has announced that it was exempting shipments of grains and their byproducts, which is the major source of their foreign currency for the nation, which needs the US dollar to meet investor demand. So there are some news that is floating around that this would basically last for a month, whereby the government will allow this exemption, and in other words, it's free of tax to encourage buyers to load up on their buying on the agriculture product from Argentina. Also for palm oil, the export figures has been positive. For both the MSPEC and ITS, there has been an increase of 8.3% and 8.7% during the first 20 days compared to the corresponding period in August. So the market indeed has been factoring in all this news flow, and technical wise, like mentioned, there is a breakdown currently, and we are looking at potentially some support nearer to the 3003 level. And for the commitment of traders for US indices, the S&P 500 registered a decrease in short position by an estimated 45K. The Nasdaq was almost flat, but maintained net short. Dow Jones saw a slight increment in net long positions. So there is indeed an ongoing hedging strategy over in the US indices, especially the S&P 500, due to the fact that there has been multiple new highs during the past few weeks, and this has been a very strong case for hedgers to hedge their portfolio positions. And moving to the product that we're going to focus on, we look at the commitment of traders for energies first. For crude oil, registered a decrease in long position by an estimated 9K, and natural gas saw short positions reduced by 17K. We come to the micro crude oil, whereby we notice the chart is still trading on a neutral setup. Basically, crude oil and gasoline prices have moved up sharply on concerns about Russian crude supplies after NATO promised a robust response to Russia's incursion into their airspace. But the crude oil prices have fallen from those levels on Tuesday's economic reports, which showed weaker than expected manufacturing activity in the Eurozone and the US. which is a bearish factor for energy demand and also crude prices. Otherwise, we are looking at a existing profile for crude oil, which is neutral, and the short-term chart setup. And as we have pointed out, that is neutral and it's been trading in a range, and therefore the rebound that we are seeing potentially is giving us a opportunity to look at a possible short position, and looking at the reference price currently at 64.50, and the potential profit price that we are looking at is at the level of 61.70, which will give us a value of USD 280. And also, should this fail, the potential loss price is above the 65.40 and giving us a value, a loss of $90. And moving to grains, have seen generally a very negative movement in overall positions. Corn had a build-up of 20K short positions. The soy complex also had a broad increment in overall shorts with 13K, 6K, and 12K added to soybean, soy meal, and also soya oil. So we can see the implications of the harvesting period that is oncoming. And of course, we are also looking at the Argentine government, who has actually been giving tax exemption for their agri products, and this will put pressure on other producers. And of course, like corn, the absence of the Chinese buyers and also increased competition from Argentina has a weigh in on prices. But if you look at the chart wise, it is definitely top heavy. The rebound has brought the market to a level whereby it looks ripe for another correction. And therefore, we are looking at a short-term chart setup of negative, although currently profile is neutral. So at the price of 428.60 is our reference price. And the potential profit price on the downward side, we are looking at 414.20 and giving us a value of USD 725 US dollar. And should this go ori, potential loss price is above the 735.40, and we are risking a value of 337.50 US dollar. So that's all I have for today. I'll pass on to Joseph. Over to you, Joseph.
All right, everyone. Morning. All right, you can see that right now the Hang Seng experienced a very strong corrections for the last 3 days. So right now it has a minor pause on the upside movement, but we still keep our stop loss unchanged at 23800 point. So let's see whether this coming October and this month, before we go for the month end, whether the Hang Seng can hold above 25,000 point level, right? And then on, this is a very timely event that tomorrow night we're going to invite Chitun, which is the our CIO from the RHB Asset, that overseeing the Chinese portfolio. That's going to share with us what is the view, right, on the China's market, right? So that will give us a very understanding, right, what's the perspective from a buy side, how they see the market. So for us research, we are actually from the sell side, but Jitun himself is actually from the buy side. So do register this event and ask as many questions as you can, and get some more views from Jitun on the perspective of the buy side. Now, so looking at the HXC, this Nasdaq index have been pulled back for the last 4 consecutive sessions. So right now, the Hong Kong market should be undergoing a profit-taking phase right now. Nevertheless, overall, technical structures remain bullish as long as the Hang Seng stay above 23,800 point level. As for the overall important names that I'll be looking at in my watch list, firstly will be Tencent, Alibaba, GDS, SMIC, PetroChina, Sino Biopharma, right? And this morning, I looked at the chart on BYD. I think for the past few days, most of the people are asking about the BYD. And as we can see that BYD has been going on corrections, and looking at the price volume profile, right, quite a lot of volume has been traded above 122, and we have set out the breakout point at 133. And for the past at least 3 months, when the Hong Kong market was undergoing a bullish phase, the BYD is bucking a trend, is actually moving downwards. So this breakout point have affirmed that the strong resistance has formed over there, and overall price structures remained bearish so far for BYD. Nevertheless, BYD potentially to stage a rebound at the first support at 100 and followed by the 88. Okay. Now, as for the GDS, right, the stocks have been consolidating around at 35 Hong Kong dollar. So on the downside, we set 30 Hong Kong dollar as a stop loss point. So same thing, you look at the price volume profile again, right? The very strong, a lot of volume has been traded at 32.5. So as long as the GDS stay above 30, right, overall technical setup remains bullish. Okay, and as for this morning, the first stocks that we'll be looking at will be Brilliance China Automotive, right? Stock code 1114. So the stock have break past 3 Hong Kong dollar 80 cents. Next resistance will be 4 Hong Kong dollar 20 cents, followed by $4.60. Downside support is $3.40. Secondly, we have Kingsoft, we have break past the resistance at 9 Hong Kong dollar. Next one will be 10 and followed by 11. Then on the downside is 8 Hong Kong dollar. Okay, and as for the Malaysia market, you can see that Malaysia market, the FKRI still remains bullish setup. We keep our stop loss at is 1535. So on the upside, right, the next level will be 1620 and followed by 1675. So based on the pattern, we think that the FKRI will continue to move on the upside. Now, as for the FCPO, after the MPOB released their data about 2 weeks ago, right, and we can what we do see is that the FCPO follow up with negative price actions, right. What we can see is that the production number continue to grow, and the inventory also have built up. Hence, at this juncture, FCPO have reached the 4350, and based on yesterday price actions, we have closed out the long positions, and right now we initiate the short positions. So on the downside, the first support is 4250 and followed by the 4150, right? So on the upside, resistance is 4005 and followed by 4006. As for the just follow up one of the counters that we have mentioned 2 days ago, we'll be looking at the Eco Shop, right? What we can see is that the price have climbed about to break past the 1 ringgit and 40 cents resistance. So if this breakout happen, right, the Eco Shop should move towards 1 ringgit 45 cents and 1 ringgit 50 cents. So again, you look at the price volume actions, right, the 1 ringgit and 30 cents do act as a very strong downside support right now here. So if you are looking at 1 ringgit and 39 cents, so the downside risk basically is a 9 cent risk with another 5 cents profits on the upside and another 10 cent reach 1 ringgit and 50 cents. So Another counter that we'll be looking at will be KSL. Afterwards, Godwin will be talk about the fundamental point of KSL, but from the technical, you do see that the KSL managed to break past the 2 ringgit and 80 cents, and on the downside, right, I'll mark this 2 ringgit and 40 cents as a downside stop loss or support level for the KSL. Okay. So for trading stock this morning, firstly, we have Vitrox that's consolidating sideways and eyeing to stage an upside breakout, testing the 3.85 cents. So breakout happen, Vitrox will be climbing towards 4.05 cents and followed by 4.25 cents. Downside support 3.65 cents. Secondly, we have Hubsing consolidated, which break past the resistance at 2 ringgit and 80 cents, extending the upside towards 2 ringgit 95 and followed by 3 ringgit 5 cents. Downside support is 2 ringgit 70 cents. Thirdly, we have the IT Max system, break past the 4 ringgit 50 cents and heading towards 4 ringgit 70 cents and followed by 4 ringgit 90 cents. So the downside support is at 4 ringgit and 30 cents. And fourthly, we have the Chiren, which eyeing to continue the bullish trajectory towards 44 cents and 47 cents. So the downside support for Chiren will be marked at 38 cents. So this morning we have 4 trading stocks. Firstly, the Vitrox, Hubsing, ITMAX, and followed by Chiren. So I'll stop here and pass on the baton to Jeffrey on the telco sector update. Thank you.
Okay, thanks, Joseph. Okay, very quickly in terms of the second quarter results wrap for the telcos, this is basically the June quarter. If you look at the telcos that have announced their results, a number of earnings misses here. That's really from Celcom, DG, OCK, Maxis a slight beat, but all the other telcos reported fairly in line sort of results for the second quarter. Overall, I think cost pressures continue to be well managed. The sector EBITDA has actually held up pretty well over the course of the last 2 quarters. Second quarter again, EBITDA has actually been fairly stable on a sectoral basis. In terms of the share price returns, let's take stock in terms of the returns year to date. I think Malaysian telcos was up 6%. This is the second strongest regional performer across the ASEAN 4 markets, ahead of Thailand and Indonesia, but lagging slightly versus that of the Singapore telcos. So if we look at the Malaysian telcos versus Indonesia was up 5.3%, Thai was 1.5% higher. But it was really the Singapore side of things that was actually trumping expectations. It was up 18%, and that's really coming from one single stock in itself. Singtel has actually done fairly well year to date, over 20% return. In terms of Malaysian stocks, Time actually did fairly well, as to be expected, 19% year to date. I think this is really the case of investors taking comfort in that the earnings are pretty much more resilient. It's a fixed sort of earnings. Axiata, not too bad, not too shabby. They're second place, 12% year to date. Just 29% rally over the past 3 months. That's really coming from the undervaluation of a lot of the subsidiaries. TM has also done fairly well. It was up 9%. The mobile telcos, Maxis, Celcom, DG were largely steady. Share prices about 1.2%, 1 to 2% in terms of year to date returns. Second quarter numbers, I think fairly good cost controls, like I mentioned earlier, but mobile ARPUs basically remain under pressure. If you look at mobile service revenue, was down 1.2% year on year in the second quarter. First half is 1.4% down. Pretty much consistent with what the management teams have guided from the telcos. They are actually basically looking at pretty flattish or single digit increase only for the whole of this year. So second half, you'll probably see the same old thing as well. There will be some pressure still within the ARPU side of things. As the prepaid market continues to contract. There's a lot of SIM consolidation happening, and all are upselling onto postpaid plans. So competition continues to be fairly tight. Consolation here is that EBITDA has actually held on well. I think most telcos are basically still exercising their very cost conscious narrative. The cost restraint is still there. Just want to point out that if you look at Maxis's second quarter EBITDA, actually grew 5%. EBITDA basically rising, EBITDA share basically rising quarter on quarter for the second quarter in a row to about 44.1%. So quite a good feat there for Maxis in itself. 5G access costs, these are the costs that they pay to DNB for 5G traffic. It has been fairly steady. I know there are some concerns here that this cost will basically go up in the second half. I think it will, but the numbers have been fairly steady on a quarter-on-quarter basis. So they're just paying about 50 to 55 million per quarter so far. On expanded SST on tower rentals, some concerns here, obviously, from the market. I think the MNOs have said that discussions are still ongoing with the Custom and Excise Department on how they should be exempted from this. But potential worst case earnings impact is still between 1 to 5% of the telco's core earnings on an annualized basis. So I think it's something that's quite manageable. On the fiber broadband side of things, I think this is actually more on the fixed line players. Numbers continue to slide quite a bit. I think promotional offers have been very competitive over the last 6 months. You've seen a lot of acquisition campaigns by TM, by CelcomDigi, and even Time, right, has actually been cutting prices and all that. It's actually the mobile operators that's been taking a lot of share away in terms of the fiber broadband business. They are basically bundling the fiber broadband packages with the mobile packages a lot better. So if you sign on into one single plan, you get a lot of rebates across both your mobile and fixed broadband segment service packages. Time obviously delivered a fairly good 3% quarter-on-quarter increase in terms of home fiber revenue. They are basically pivoting towards the single dwelling units or the landed residential segment. Previously, they were very much focused on multi-dwelling units, apartments, but they've since rolled out their fiber into homes as well. CelcomDigi obviously has been very aggressive. Since the start of the year, been upselling a lot of their fiber broadband plans. CelcomDigi basically rides on Unifi's fiber as well as their own fiber. So they are actually making a bit of inroads into the fiber business. But overall, I think the growth in terms of the fiber side has actually slowed quite a bit. That's also a reflection of increasing penetration. In terms of the earnings adjustments for the quarter, we've made some revisions downwards for Axiata, CelcomDigi, and Maxis. This is mainly to reflect the very soft top line. There's been some adjustments for housekeeping as well in terms of the traffic numbers for the fourth quarter due to the changes within the 5G access cost agreements. I just want to mention that if you look at Axiata's numbers in itself, second quarter was some would consider that as a miss, but it basically came in within our expectations. This is a stock that it's a bit of a tough sell here, obviously, for the fact that valuations are still very undemanding. People are still questioning the upside coming from some of the other opcos. But if you look at the financing costs and all that, it fell 27% in the first half. Quite steep fall there. That's really coming from the repayment of their USD holdco debt. So I think this is a narrative that will continue into second half of this year into FY26. They are basically looking to monetize more of the assets, and with proceeds from this, it will be used to reduce borrowings. So overall, there are no change in terms of our sector call. It's still neutral. Top picks are TM, Telecom Malaysia, CelcomDigi, CDB, as well as Axiata Group. Okay, that's all from me. I'll hand it over to Godwin.
Okay, thanks, Jeff. Yeah, so let's move on to KSL. We have a non-rated note this morning. So KSL is almost a pure Johor property play that is set to benefit from the Sing dollar-driven retail spending as well as the pickup in economic activities driven by the JSSEZ incentives. So the company has almost 5,000 acres of land, of which 4,600 acres or 93% of the land bank are located in Johor, and of which 53% of this land, which is about 2,600 acres, is in the prime areas in Iskandar, Malaysia. So the remaining land is in Klang and also Setia Alam. The company also owns a few investment properties, including 2 retail malls, KSL City Mall, as well as KSL Esplanade Mall in Klang or Banting here. There are also 3 hotels. So the investment property segment contributes almost 20% of the total revenue. So although the market has turned bullish on the Iskandar Malaysia property market since second half 2023, the stock is still relatively underinvested, which we think should change when management meets more investors ahead. So in line with the industry trend, KSL property sales increased substantially from just under 1 billion before the pandemic to 1.4 billion in FY24. And management has set a target of 1.2 billion for FY25, given the timing of launches as well as the approvals. So first half, the KSL launched about 220 million worth of projects, but in the second half, they will launch about 3.5 billion worth of projects. So apart from the pent-up demand for housing, the Sing dollar driven spending has also significantly benefited KSL City Mall, which is located in the city center of Johor. And the mall mainly houses the businesses that provide affordably priced services, such as beauty salons, massage centers, and also manicurists, as well as grocer. So the mall's current average rental of 23 ringgit per square foot is significantly higher than that of other malls in the vicinity. As for the development margin, KSL EBIT margin of 35 to 40%, excluding the pandemic years, for the property development division is also significantly higher than the industry average. This is largely attributed to its low land cost, maximization of land efficiency, product pricing, and in-house construction arm. Management has also opportunistically acquired a few parcels of land during the pandemic, and also from a few distressed landowners over the last few years. The more recent land transactions or the more recent land acquisitions are from Tropicana Corp, whereby the company actually bought 2 parcels from Tropicana. Earnings contribution from the retail malls should strengthen from FY26 onwards. The lease for one of the anchor tenants in KSL City Mall, Lotus, is expiring in early 2026, and its renewal should lead to a substantial increase in rental revenue. Lotus will also be occupying space in KSL Esplanade Mall to replace the existing grocer there. And given that Esplanade Mall is relatively underperformed with only occupancy rate of 45%, the new tenant Lotus should help to attract more shoppers as well as retail tenants to the mall. So our valuation, our indicative fair value for KSL is at 450, and this is based on 40% discount to RNAV. Although this is above 1 times price to NTA, NTA is at 4.17 ringgit. KSL's low land cost, above industry profit margin and ROEs, and the valuation upside for KSL City Mall should justify our valuation for the stock. So yeah, that's all from us today. So happy trading, and hope to see you all again at our RHB Morning Kappa at 8 tomorrow. Thank you.